Holy cow, I can't believe it's already October. And if there's one weird thing that happens during the month of October, is that suddenly people have this irrational fear about the markets. So in today's video, I'll explain to you this weird phenomenon called the October effect. But more importantly, a light-hearted take with facts about how you should be really calm about the potential of market corrections. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest and feel better about money. So let's be honest, if you've been following the markets at all for the past year or so, or maybe even longer, you would have heard about potential market crash probably more than once. And it's that irrational fear that bad things tend to happen in the stock market during October, which is what people refer to as the October effect. Historically, here are the three things that brought about this fear. The first event was nearly 100 years ago during 1929 when the stock market crashed and actually triggered what we refer to as the Great Depression. On October 24 of that year, the Dow Jones Industrial Average, or the Dow, crashed by 11% in one day. And that day is therefore known as Black Thursday. And if the 11% drop wasn't horrifying enough, the market actually continued to fall even more right up to its bottom in 1932. So from the peak in 1929 to the bottom of July 1932, the Dow lost 90% of its value. And it didn't reach its peak until 25 years later. And if that fact doesn't really freak you out, I don't know what will. Next is October 19 of 1987, which in history now is known as, unsurprisingly, Black Monday. The Dow lost about 22% on that day, with the S&P 500 coming close to that loss as well. Fun fact, if you thought that was bad, unfortunately the Asian markets were worse. Singapore Stock Exchange lost about 40% of its value, and in Malaysia it lost about 30%. And the most recent October incident was during 2008. From October 6 to 8 of that year, the Dow lost about 18%, with the S&P losing over 20%. It was also the month that I so happened made a migration attempt to Australia, and unfortunately that failed because the markets were crashing even until January of 2009. People were still getting fired. The most vivid memory for me was waiting in the lounge of an office for an interview, and I was going through the newspapers and reading that in Sydney there was a role for a janitor which had 900 plus applicants. So that's why October has a special place in my heart, but also in the heart of people and investors in the markets. So you might be asking, hey, is there any basis to this, or is it just all superstition? And the long story short is that nope, there's no basis to it. And if you look deeper, you'll also find that some of the incidents happened in the months before October. Just so happened October was the month that things fell apart. And hey, if you're enjoying this video so far, I'd appreciate your support in clicking that like and sub button, because that really does help my channel grow. Thanks. Now let's get to the few facts that I hope will give you a sense of calm in the face of potential market corrections that everyone seems to be talking about. So firstly, a market correction is something that actually happens quite commonly, and it's defined as about a 10% drop from the highs. Now, in case you didn't realize, the broad market of the S&P 500 already encountered that sometime in October and September of last year. By and large, we are still in a technical bull market when you do look at the S&P 500. And since World War II, there have been about 26 market corrections in total. And that's not bad, right? If you think about it, 26 times within a span of about 70 years. And this is unless it falls by about 20%, which is when it would be officially termed as a bear market. But the silver lining is that it only happens about 20% of the time. And while that might sound a little scary, it's actually not really, which is the second point. Now, even if a bear market does happen, on average it lasts about 15 months. And since 1966, the worst period was actually during the dot-com bust, when it took about 2.5 years to clear the bear market. The shortest bear market was what we went through last year, during March of 2020 when it technically only lasted 33 days. Now you might be saying, how is that coming? It's still 15 months, it's still 2 years, maybe. So I'm saying that on the surface, while we can look past that time period, I also do find a little comfort that on average bull markets last way longer than bear markets. An average bull market is about 5.5 years versus the average bear market of about 15 months. And you might be saying, that still sucks. But there's another way of looking at it, which is my third point, that whether it's a correction or a bear market, you can see it really as an opportunity. While it's never comfortable for you to watch your portfolio decline in value, if you were a longer term investor, you can see a drop in price actually as an opportunity that's great. And it doesn't matter whether you're investing in ETFs, individual stocks, robos or whatever, as long as your analysis is saying that, hey, this is a good value, whatever that you're choosing to invest in should be technically better value if the price is lower. So if your analysis hasn't changed, you should be like throwing up your hands in joy saying that, hey, this is a fantastic discount. The next comforting fact is for those of you who are struggling to invest because you're wondering if it's the right time. Now what I'll talk about is a classic analysis that's fairly popular amongst the financial independence community. In a nutshell, they simulated 3 different investors, each having the very same $96,000 to invest over a total of a 40-year period into the S&P 500. So the first profile, Tiffany Terrible, has the worst timing ever and she always invests right before the market crash. And after a 40-year period, she ends up with about $663,000. The second profile, which is Brilliant Britney, tends to time the market perfectly, always buying at the very bottom, and she ends up the period with $956,000. The final profile is Steady Susan, which ignores market timing, invests consistently every month come rain or shine, and guess what? You can probably guess it. She ends up with about $1.38 million. Now, as you can tell, the moral of the story here is about consistent investment and not really trying to time the market. And that on its own is pretty good. Now, my additional takeaway from this story is that to acknowledge that we are imperfect. Even if we net come out somewhere in the middle, if you are consistently investing over a long period, you really can't go wrong. And that alone, I think, is already very comforting to me. Now, the final calming fact is for those of you who are younger investors with a long investing horizon in the future. Remember that the bulk of your investable money is likely in front of you versus what you currently have in your portfolio. So let's use a scenario as an example. Say your portfolio right now is $50,000 and you have about $1,000 to invest in every month. Now, even if you don't add more to your monthly investable amount, within a span of 5 years, you would already have more money in the future to invest versus the value of your portfolio today. And that's just within 5 years. If you were somebody with multiple decades ahead in front of you for investing purposes, hey, that $50,000 today is really a small portion. So how do you keep calm and invest on in a period that might be a little fearful? Let me know in the comments below. So thanks for watching, guys. If you got value out of this, I would appreciate your support in clicking that like, sub and bell button, because I'll be back again next Sunday with a brand new video. And until then, you take care, happy October, and keep playing your own game.